Hi friends, welcome to Insurance Decoder, and in this video I will tell you about Jeevan Umang policy of LIC, which is LIC's table number 945. In this video you will get to know about the features of Jeevan Umang policy, the premium for Jeevan Umang policy and the examples. We will also take that how the maturity benefit and the death benefits are calculated and all other things that you will get to know in this video. After watching this video, all your queries, all your questions related to Jeevan Umang will be solved. So let's start. Friends, when we earn, we have certain kind of things. We do jobs, we enjoy life and partying, we buy houses, we buy cars, we even go on vacations, and we give good education to our children. So this is how we do when we are earning. But what happens if the person is retired? He still has dreams to party. He still wants to go on a foreign vacation. He still wants to buy a good car. He still wants to buy a good house, and he may be having different kind of medical requirements. And generally those medical requirements increases when you grows old. So this person thinks that he wants to buy a car, new house, holidays and medications, but his wife consoles him saying that we can dream only because we do not have big funds. Why it has happened? Because these persons, they have not made the financial planning when they were earning. During that time, they spent most of their money on parties, on foreign tours, on cars, and because of that, they did not sufficiently secure their future. So for these kind of requirements, LIC presents this policy, Jeevan Umang policy, which provides you 8% of sum assured every year, survival benefit, maturity benefit, endowment, and whole life policy. So even after the maturity of the policy, you are secured till your last breath. So up to 100 years, you are safe. Even if you die anytime up to 100 years, your family will get the money. So this is how this policy works. So eligibility criteria, minimum age at entry is 90 days, and premium payment option. So it gives you different kind of options. You can opt from that. You have premium payment option 1, 2, 3, and 4. And other under these options, your premium payment option will be 15 years if you are opting for option 1, 20 years if you are opting for option 2, 25 years, and 30 years. So depending on your requirement, you can opt any of the 4 options. Maximum age at entry, say for option 1, maximum age at entry will be 55 years. For option 2, it will be 50 years. For option 3, it would be 45 years. And for option 3, it would be 40 years. And the minimum sum assured is 2 lakh rupees. And there is no limit for the maximum sum assured. You can take any maximum sum assured depending on your financial conditions, depending on your requirement. You can take the policy. So this is how the eligibility criteria of the policy is. Now we take the examples that how this policy will work. First, we take the examples when the policyholder remains alive till the maturity. What will happen? We take the examples that the age of the insured person is 30 years. At the age of 30 years, he thinks to buy this Jeevan Umang policy, and he buy an insurance policy of say 10 lakh rupees sum assured. So for that, he will have to pay a premium of around rupees 30,980 every year. And the premium payment is for 30 years. He has opted for the 30-year option. So total premium he has paid in 30 years is 30,980 multiply 30. So 9,12,000 he has paid to LIC. Now at the age of 60 years, since he has taken the policy for 30 years, so 30 plus 30 is 60 years, his policy matures. And then from that date, policy holders starts getting 8% of sum assured, that is 80,000 every year. So this is how this will work. In our case, the sum assured is 10 lakh. So 8% of 10 lakh is 80,000 every year. So from 60 years onward, he will be getting 8% of sum assured every year. So this is how it will work. And then the premium will stop. He will not have to make any kind of premium. He will keep getting this 80,000 every year till he reaches attain the age of 100 year. When he reaches at the age of 100 years, this policy will stop and he will be given the maturity benefit. If the person survives after 100 years, in that case it will happen. So he will get the maturity amount of 79 lakh 80,000, and this will include sum assured of 40 lakh, 10 lakh rupees, bonus of 44.3 lakh, and final additional bonus of 35.50 lakh. So this is how this will work. When the person remains alive, he gets a, a say pension, 8% of sum assured every year after the maturity of the policy till he dies, or up to 100 years. And if he does not die till 100 years and he remains alive up to that date, then the insurance company will make the full payment of the maturity amount, and that will come up to 79 lakh 80,000 rupees. Now we take the second condition. So let's see how this worked. Total premium this person has paid is 9 lakh 12,000, and total receipts are annual returns 40 multiply 80,000. So from 60 years onward he started getting, and he got it up to 100 years. So 40 multiply 80,000, so 32 lakh he got as the pension every year, and the maturity amount is 79 lakh 80,000. So it will be roughly around 79 plus 32, 1 crore 11 lakh rupees. So he paid only 9 lakh 12,000 and he got 1 crore 11 lakh rupees from LIC. This is how it will work for this person. So this is quite a good buying option available. So commencement of risk. Since this policy can be bought for a kid also, so there will be a commencement of risk option will also be there. So if you have bought this policy for a child and he is 8 years old, then this policy, the risk commencement of risk will start immediately. And if child is below 8 years, then it will be having two conditions. It will, the risk of will start after 2 years of the policy starting date, or it will start when the child attains the age of 8 years. So whichever happens first, this will happen. So how this will work? Suppose in policy holder is 7 years old, then risk cover will start after 1 year when he will attain the age of 8 years. So in this case, he will have to wait for 1 year only. After 1 year, he will become 8 years. So his risk commencement will start. In second case, policy holder is 3 years old. So in this case, the policy risk will start after 2 years. So once he will attain the age of 5 years, then this policy risk cover will start. How this affects, that I will tell you. Let's see that in first case, if policy holder dies before maturity and risk cover has started, that means the person is above the 8 years or he has been in policy for 2 years. So age of insurance buyer is say 30 years, and age of buyer is 100 years, then this policy will mature. So this person dies, policy holder dies when he is 50 years. So after taking the policy within 20 years he dies. So what will happen? The insurance company will give him the death cover. This death cover will include the policy amount plus bonus for 20 years and final additional bonus if it is there. So approximately he will get 10 lakh rupees plus 10.29 lakh bonus plus 1 lakh rupees final additional bonus. So total his family will get 21.29 lakh rupees. So this is how this will be calculated. So as the person survives longer, this bonus and final additional bonus will keep increasing since the policy amount will remain same throughout the policy. However, this bonus and final bonus, these they keep increasing as you grow older. And in the second case, we'll see that if the risk cover has not started, in that case, the premium amount minus GST and other charges will be paid to the nominees. Other features of the policy: riders. With this policy, you get different riders. First rider is term plan rider. Second rider is accidental death and disability rider. And third is accidental death rider. And fourth is critical illness rider. You can also take loan against this policy, and you can get the surrender of the policy. If you want to surrender the policy, you need to have paid at least 3 years premium, and you also get the tax benefit under this policy. Payout options, the payout options available, you can get the maturity and death claim amount in a lump sum payment in one installment, or it can be taken out in different installments, say 5, 10, and 15 years options. You need to note here that this option needs to be exercised by the policyholder only. If the policyholder dies, the nominees cannot exercise the option of availing the amount in installments. And the LIC pays you interest if you opt the installment option. So this is how this functions. I hope this policy you get to know in clear detail. If you like the video, please don't forget to like the video, give your valuable feedback in the comment box. And if you're not subscribed to my channel, please subscribe to my channel and hit the like button. Share it with your friends. And thanks a lot for your valuable time, for your comments, likes, and sharings. It makes my day. Thanks a lot.